Ticker symbol CELH is down around 52% for the past year and a lot more from its recent highs. And the truth is that this stock has not stopped falling since June 2024. But today we'll be looking at a great business which is fighting against giants and is actually managing to steal market share. And the key question today will be, can this company maintain its growth? Because it currently has solid fundamentals, rising efficiency ratios, and well, its revenue has risen by over 56% year over year. But then why has its price decreased so much? Today we'll be looking at Celsius Holdings, an energy drink company. In their annual report, they state that their mission is to inspire people to live fit with the essential energy to achieve their goals. Now, of course, they offer energy drinks, but these drinks are made up from clinically proven formulas which are aimed at positively impacting consumer health. There have recently been so many studies about Monster, about Red Bull, investigating how these beverages are actually bad to your health. However, in theory, Celsius drinks are backed by clinical studies and they help you accelerate metabolism, burn body fat, and just increase your performance. These products are sold through major retail channels including grocery stores, convenience stores, and even their own e-commerce. One of the main reasons why it has been so successful is because they recently expanded distribution agreements with, first of all, Suntory in the UK and Ireland, but most importantly with PepsiCo. Now they did this in order to improve their distribution worldwide, but also in order to enter such an attractive market as Canada. This has been a very bold strategy, and Pepsi actually invested around $500 million in this company a couple of years back. Now there is one minor red flag, which is that Pepsi represents around 60% of total net revenue in 2023. Now, when we're looking at these companies, we want to analyze all the possible risk factors because it's a high growth, high risk company. So this is what we should be doing. And of course, this represents a risk because what if PepsiCo decided to sell their investment and leave Celsius? Well, this would decrease their revenues by 60% in an instant. Of course, this is extremely rare because the company is performing very well and Pepsi has actually allowed it to reach new highs. However, it is something that we should keep in mind. Now, their main strategy can be broken into two different parts. The first one is to continuously develop new products, variations, and flavors, such as Celsius Essentials, and even different forms of Celsius. And the strategy number two is to leverage their distribution agreements, of course, not only with PepsiCo, but with other brands worldwide, to enhance market presence and distribution capabilities globally. I believe that in this year, 2024, they have already entered around 4 markets, and they were also willing to enter 2 more, with France being one of them. But now, let's move on to their financial analysis because this looks incredible. They currently have a return on capital employed of 28%, which is amazing. It means that they're very efficient at using their assets and investing them correctly to get a very good net income out of those. Now, they have a very high interest coverage ratio. They basically have zero debt to worry about, and they have an insanely high cash conversion rate of 90%. Now, this company has a profit margin of 50% and a net margin of 20%. Both of these KPIs are above what we usually expect for, especially that operating margin, which is above the 15% threshold we usually set for companies. And now this is where this company becomes incredible. Their gross profit, revenue, and net income have grown every single quarter. Now we can see that the revenue has soared around 56% year over year, and both their gross profit and net income have increased by a lot more because their margins have been expanding. However, we do have to state that recently their net income has been slowing down, but we'll have to see what this does in the future with their further expansion. Now, of course, this usually goes hand in hand with the efficiency ratios, and here we can see that they have been rising in the past. The one that we should focus over here is return on invested capital, which is sitting way above 80%, and those are some great numbers which are generally only seen by software companies. So the fact that a company selling a physical product such as an energy drink is able to pull these numbers out is amazing. Another leverage analysis looks great because they do have leverage and liabilities in order to funnel their growth. However, they're being very responsible about it as their total assets are way above them and they're leveraging more equity than debt in this time period. Two things which I believe are very nice for companies to keep doing. Now, when we move into their fundamental analysis, they get a solid 5 out of 8 ticks, starting off with a low liability risk because they have a very high interest coverage ratio as we discussed. Now, they have a very solid balance sheet, and this is due to the fact that they can pay all of their short-term debt only with their current assets. And this company, of course, as we have seen, is able to grow their revenue organically. And now the two most important things about this slide is first of all their pricing power and second of all their existing moat or competitive advantage. Celsius drinks are everywhere in the United States right now, and the reason why people have been making the change from giants such as Monster Beverage or Red Bull is because a lot of articles and a lot of news have been coming up about energy drinks, telling that they're not healthy, that they're unsafe, and that you should potentially not drink them as much as you do. Additionally, in some countries, they have put some restrictions where you have to be of age in order to be able to purchase energy drinks. Leveraging this, Celsius has positioned itself as the alternative for people who wanted a safer energy drink, which not only tastes amazing, but has health benefits. By conducting a lot of research, clinical trials, and getting the opinions of experts, they have been able to create a very positive brand image. And this has actually allowed them to become the third most purchased energy drink brand in the United States, which of course has allowed them to scale up, and this is allowing them to build their moat. Of course, they're not at the point where they are a Red Bull or a Monster Beverage, because that takes a lot of time being at the top of the food chain. However, I believe that the combination of their brand, this scaling up of operations, and their partnership with PepsiCo, not only the distribution, but PepsiCo actually being a very big owner of this company, is allowing them to create a very big competitive advantage, and their positioning in the market is allowing them to have pricing power. Because instead of choosing to enter the market as a low price beverage, they've decided to enter the market as the healthy alternative. And we all know that nowadays, healthier alternatives are able to sell at a greater price and attract more demand at the same time just for having those benefits. Now, there are three things that I didn't like, starting off with their cash flows not being consistent. Now I'm very picky with this. I like companies who generate great amounts of cash flows every single quarter. However, in the case of Celsius, some quarters were close to zero free cash flow generation, and some quarters were amazing. Additionally, in the latest quarter, I actually did not see that organic free cash flow growth. Now, it is amazing that they're being able to grow their revenue organically. However, they don't translate this into organic free cash flow growth. I don't see that much value. Of course, they do not pay a dividend and they're not conducting any share buybacks. This is not a negative, it's just due to the fact that this company is still in the growth stage. One good thing is that this company has not been issuing shares, so the shareholders had not been significantly diluted in the past years. Now, when looking at their valuation, this company will always trade at a bit of a markup because they're growing at a pretty fast pace. However, due to the recent pullback, they're currently trading at a price to earnings of around 30 times, which is cheap considering its historical PE ratio. Now, it is trading down, of course, because people are wondering whether it can keep its long-term growth, but it is currently yielding a 3.3 free cash flow yield, which is above the 3% long-term inflation rate, meaning that by following this method, it is also trading at an attractive valuation. Now, when looking at the risk and possible challenges, I first of all see the worsening competitive landscape. The beverage industry is extremely competitive, with a lot of giants such as Monster, Red Bull. You can even say that Coke competes in this space, and the moment that these competitors see that something is working that they're not offering, they will for sure immediately try to replicate and improve that offering. And we have already been seeing this with these brands offering healthier beverages, in the same fashion that Coke introduced Coke Zero when it was facing backlash for the normal Coke. Now, the second one that I see is regulation, where possible regulation changes may impact this company. So now before we move on, please remember I'm not a financial advisor and this is not financial advice, so please do your own due diligence. However, I believe that this company is developing a strong competitive advantage and it has a very high return on capital employed, meaning that it knows how to create value for the investor. However, it's not generating consistent cash flows and they are not predictable. So I believe that this is a good company and it will probably be a great investment. However, it has high market expectations, and whenever a company has high market expectations and it doesn't deliver in one quarter, things do tend to get scary for shareholders. So thank you for watching. As always, this has been the Cashflow Compounder. Join the free Patreon for extra content, and there's a link in bio for a free stock if you join Trade Republic.